Welcome once again. M. Solomon, accountant, auditor, secondary market specialist. We're talking about foreclosure today, foreclosure accounting, foreclosure fraud, and we're going to focus on substitution and delete. What we mean by that is where you're looking at one set of numbers and they're being substituted for another set that have been deleted. You can reach me, by the way, at 202-550-8364 if you'd like to learn more about what we do as far as accounting and auditing. You should get a good idea from this presentation. And if you want to send me information, I'd love to see your servicing statement, most recent servicing statement if you have a foreclosure issue or you're in default. Send me your servicing statement and be sure to ask for a payoff demand. We need that payoff demand. From there, we can go to work and no charge to review that information. Tell you what we think you have. And let's get going. Today we're going to be talking about the courts and the payoff statements. I said you should be able to get you should request a payoff statement. It's important that you get one. There's a number of reasons why I'm going to show you. And the courts are using the numbers provided off these payoff statements in order to come up with the, in a judicial state, for example, where this case is, I'm going to show you. It was necessary for coming up with the judgment amount and the actual cost of the mortgage at the time of the sale so they can determine any deficiency, assuming the property sells or even if it goes back to the lender. So we're talking about courts and the payoff system. Here you can see an actual case. We're looking at the page of the order. This is actually a order affirming the sheriff's sale and confirmation, I guess you would say. And this was for a foreclosure that took place less than a year ago. So what we're talking about today is manipulating data, and that is the manipulation or manipulating or rearranging formula. It involves the same process of manipulating or rearranging equations. What you basically have is the left to right side. In this formula, for example, I think that speed equals distance divided by time. S, your speed, equals the formula. What we do in the manipulation of data as accountants is you can reverse that. You can have the formula is equal to the answer. So it really is reversing. By convention, the subject is always placed on the left hand side of the equal sign, although S equals D slash divided by T means the same as D slash D divided by T equals S. So it's just reversing it from left to right, right to left. And it's used, it's nothing necessarily corrupt or fraudulent about it. It's used for training, for educating kids in school, and has a certain appeal in certain kinds of industry and sectors. But in this case, we're going to show you how the manipulation of data is killing you and is robbing you of your title in your property and leaving you with the most obscure defenses I've heard recently. You really want to focus in on the numbers, and that's where I think you're going to have your best shot at defending yourself and your property. We're not attorneys, by the way. We're accountants, and we can't advise you on your legal rights in property. We can only testify in your case and act as your accountants and show the court what we found. And if there's something that merits the foreclosure defense, then we certainly will find it. Let's continue. Okay, here we're looking at the case of the order for entry, or excuse me, the confirmation of the sheriff's sale. And what we found, we're going to show you here in a few minutes, what we found is, first and foremost, an interest calculation that was suspect. The interest is calculated through the date of sale with no reference to the last payment made. Well, how can you come up with the interest due if you only have the interest through the sale date? You need to have the last payment made to properly calculate all of the accrued interest that you're charging the consumer in a foreclosure. Next was the principal balance. The amount remains fixed for the life of the loan, where the interest accrues and fees compound in a mortgage. I'm going to say that again. The principal balance in all of these cases is a fixed amount. It never changes from the servicing statement to the date of the foreclosure. In a conventional mortgage, you're going to have interest accruing and fees added to the principal balance. That principal balance will continue to grow, and that is a marked change from the way things were done just 10 years ago, backdated to 100 years. In this case, we also noticed that legal fees were out of this world. It was $80,000 for a loan that was under $200,000, $80,000 in legal fees. That was worth over 46% of the foreclosure cost. Now, what we believe is happening with these legal fees and some of the shenanigans we found, and we did find a good degree of questionable line items. What we believe is the attorneys are having to recreate the basis in the asset because all foreclosures are really substituted for a constructive liquidation of a tax matter partnership. And that's where you're seeing the trust and the trustees and the so on and so forth and the different players involved. So what we believe they're doing is creating the cumulative cost, which in accounting is known as your basis and asset. That's your cumulative cost. The contrived payoff statements appear to represent the value of the real property, not the mortgage. Under the installment sale rules, that makes sense. We'll save that for another presentation, though we want to identify any fraud we found in this particular file today. Manipulative calculations. We just talked to you about what manipulation is. It's taking advantage of the consumer's good faith under contract and fabricating a payoff where the mortgage was in fact canceled. Now to the actual case. Here you can see the page that was taken from the confirmation of sale. See here the additional amount set forth in the motion to confirm share of sale shall be added to the foreclosure judgment as requested by the plaintiff. Well, the problem I got, if you're an attorney, please feel free to comment. All of you, if you have any comments about your own case or situation, feel free to comment. We're looking forward to hearing from you. Here we have a judgment amount for $59,057. Sorry, it's not more legible. $59,057.23. And what is significant here is that the court was aware and they were privy and had all this information available to it. When it issued the order for judgment, though, it only issued the judgment for $59,000 and change, which is the number for the fixed amount from the servicing statement. Why is that? We question it. If you're an attorney, please feel free to comment and tell us. I would argue that, though. The interest that was due, as I said, was through December 2nd, 2021 for, I think it was $20,770. But we don't have any reference as far as a rate, or more importantly, how far back are they going? To what date did they calculate this interest due, and where's the per diem? I'm definitely questioning the interest as an accountant. We have property taxes. Those have to be paid, and the rest are nothing but garbage fees. And I take exception with this one, which is absolutely beyond garbage. That's attorney fees of $80,324. $80,324 attorney fees on a total due at sale of $171,241.95. So what I'm focused here on is the fixed balance, the amount of interest, how it was calculated, why, excuse me, they're getting a attorney fee for $80,324. I know why. It's to help create the basis of the asset, cumulative costs. These are the questions that we're asking, and that's all based on a sale of the property that is confirmed in the amount of $170. So as an accountant, we're going to point out any deficiency here. At first glance, you have a deficiency. The total amount due at sale was $271,341.95, and the sale of the property of the plaintiff is confirmed at $170. So the difference there between $171,241.95 and $170 is $1,241.95, $1,241.95. That's no big deal. But let's look over here now. Sheriff's sale went down. This is our analysis. Sheriff's sale went down on 2/1/21, and the total due at sale, $171,241.95. We deducted we subtracted out the sheriff's sale, which was $170,000, and again you get the margin, $1,241.95. Okay, that at face value is no big deal. Okay, the lender had to suffer a loss of $1,241.95, and it's no big deal. The lender got pretty much made out whole, and the borrower's out of the house. He lost his home, but that's not exactly what you're looking at. What we found out was that represents two numbers. One, it's almost on the mark to the next payment due. In fact, it actually is on the mark if you factor in $2, because those aren't dollars, and that's what I'm trying to say. Those are something else. They're days. This is an insider track for representing something that doesn't exist. Those are the days that they're calculating, and the next payment also happens to be $1,244, which is a number. So they've got the next payment due and the number of days that backdate to the date of the borrower's last payment. Let's jump over here. Next payment due was 7/1/18. I got that from the consumer. If I add 1,249.95, that gives me 11/23/21. Department of Treasury says tie out these legacy loans with a 7 number 7. That would take me to the end of the last payment, which would have been 11/30/21 if this loan was still current. That means the next payment due was 12/1/21. These loans are not in default, they're current. They're being serviced by you under a 1099. So the next payment due is 2/1/21, and the sale was on 2/2/21. These deals fall under the installment sale method of accounting, where at least one payment is made after the year of disposition. So that one difference there is going to be tacked on to that to make the end of the year payment. And what you have here are contrivances. This margin here represents days, and I'm going to show you what those days are worth. As dollars are worth one more payment, but as days, let me show you what they're worth. Again, same document, due on sale 12/2/21. That was the sale date, and the property sold for $170,000. Due on sale was $171,241.95. We said the difference was $1,241.95. Look at the share price. Those are days, those are numbers, those are also shares. Shares have been substituted for your per diem. So that's not a per diem of 137.88. That's your share price. So 1,241.95 days, we said, took us from that date to the last payment made, but using a 137.88 price per share, that recapitalizes the cost. So that cost was recapitalized. There was no cost until the share of sale. And that sale was based on shares being sold, not real property. So I am going to go on record and say that was not a real sale. And it did not sell to a highest bidder. It sold, which is crazy. It sold to the plaintiff, where there were no higher bidders. It said the plaintiff was the highest bid and therefore prevailed at the sale. This was not a sale. It was a lender taking back a property as an REO. There's a lot going on with this case, and I'm so happy for the consumer because they've been getting nowhere with the case up until we got involved, and it's exciting to see where we're going to go. It's also very disparaging and very saddening to see this is happening to a couple that is in their retirement, and certainly this is what I'd call an abusive transaction, an abusive case. If that's not enough, we're going to take a look at something called CONTRA, accounts for a zero balance. This is more of the manipulation we're talking about. We're using the same numbers here, 59, 20, 9. You see, all the same numbers we've listed with one exception. We're going to use the total due on sale, but we're going to start with the amount of an allonge. The allonge is a blank endorsement that's attached to the note that goes to the creditor. The creditor is the one that funds the lender's loan. When Countrywide or any lender makes you a loan, they're not getting the money out of their bank or out of the bank account. They're not getting the money out of their pocket. They're getting the money from a lender. That's a commercial lender, and that lender is going to hold the collateral, the note, and the entire file. That really technically means that until the loan is sold, the lender is not the holder, but is entitled to enforce, and it's the creditor who's the holder, but not entitled to enforce. Puts them in a very odd predicament, and it also puts them in a situation, if that allonge was to be carried out beyond 180 days, in a situation they're going to be hard-pressed to prove how that assignment was endorsed and made real. But using the allonge, it was valued at $82,000. I'm shocked that they would have left that in file and tried to use that as part of their foreclosure scheme. So I used the $82,000 allonge value for a creditor that was due from the seller, the lender, and we subtracted out all of these numbers. And what you see is these numbers pay off the outstanding. They pay off the $82,000, then start to build a surplus. And what I'm left on the trial balance is $89,241.95. Now, if I take the $82,000 as a credit to pay off the debit, the allonge, see, I started off here and I end up here. It brings me back to $172,241.95. That perfectly balances. Balance sheet balances. So what you have is a demand for payoff for a lender's obligation owed to the creditor, JP Morgan Chase by Washington Mutual, let's say, and it's being credited back here, and that comes out to $171,241.95, which is the amount that they said was total due. Someone might say, okay, well, you're adding a third-party obligation here, and the real party of interest is going to say, why should he pay for it? Well, he's probably paying for it because he's obligated, and look, he's going to get credit back for it because look at the attorney fees. That is why they're charging the excessive attorney fees. if you take that number there and add these up, you're going to pretty much get close to 82,000, right? 3, 5, close. Yeah, close. You're going to be close. So you can see that this is a contrived fee, and it's all used to establish a basis in the asset because these deals are part of a constructive liquidation for tax matter partnerships. I believe it's under Section 451 and Section 108 of the IRC, Title 26. But the important thing here is the amount owed by a third party is verified and filed. It's 82,000. And the total due at sale after adding the 82,000 debt is 171,241.95. So a lot of potential counterclaims here that should be sufficient to get this case judgment and sale overturned. I'm not an attorney. Only an attorney can make those kind of calls in terms of what they think is going to happen in this case, but I will say that this is a very contentious argument, and the preponderance of evidence here is in the favor of the homeowner, the title holder, or the original title holder. So to summarize what we're talking about here, the payoff statement is a concealed scheme to represent a mortgage that was canceled and the title transferred from the origination. You lost title at the origination, and the debt was canceled, which is going to result in a 1099 to you because it's treated as ordinary income, subject to a 30% withholding rate. It's not a mortgage. The mortgage was canceled, and basically they scheduled the disposition of the asset, the whole loan file, as shares at the time of the origination, which means you never had a chance. There's no way. These are structured financing arrangements, and they fall under manipulative accounting methods. The methods and means for constructing the payoff statement involves reconstituting a zero balance. All foreclosures are taking place at zero. I hope you enjoyed our presentation. Again, I'm M. Solomon. This was an actual case we looked at, and it's still an open case. You can reach me at 202-550-8364 or secondarytradedesk@gmail.com. We're foreclosure accountants, accounting and auditing, and if you have a servicing statement, please send it to me at the email. And if you also have a demand for payoff, I'd like to see that too. No charge. We'll do that analysis and then filling in on how much we charge for our accounting and our auditing. And we hope to see you soon. Be sure to leave a comment if you see anything here that rings a bell or looks familiar to your case, or if you have any comments you want to make. Attorneys, feel free to make a comment. We'd love to know what your take on all this is. And look forward to talking to you again. Be sure to subscribe. Thank you.